It was a tumultuous week in financial markets. So let's take a look at the big picture. Also, I'm going to give you some tips on stabilizing your investment portfolio, keeping you safe, and also keeping you on the path towards your retirement and financial goals. I'm Ron DeLegge with ETF Guide. Let's get to it. So if we take a look here at the big picture view of major asset classes and some of the ETFs tracking them, this is since the start of 2025, and we can see a big drop off this past week due to announcements that were made by the White House. I'm not going to mention the word. It rhymes with sheriff, begins with a T. Like I said before, I'm not going to say that word. Rhymes with sheriff, begins with a T. You're not going to trick me. So we had lots of mention of sheriffs this past week. And of course, none of the financial markets liked it. And that is the judge, the sole judge of what the market thinks about the current policies being made. And of course, not just what's being said, but then the daily changes and the daily swings of what's said, and then something else comes out that contradicts that. So there's lots of contradictions and unknowns. And so financial markets at this particular time don't like that. Nevertheless, if you look at the relative performance, we see that bonds, BND, and commodities, SDCI, are much better performance than some of these other areas like U.S. stocks, S&P 500, SPY down about 13.5%, and then Bitcoin, IBIT, down about 10%. Those of us that have believed or bamboozled into believing that Bitcoin is a safe asset, well, not necessarily. It's still a very much, as with all cryptos, it's a risk-on asset. And it's still also an asset that is in the process of maturation. So it's natural that cryptocurrencies would not necessarily be a haven of safety because of the fact that they lack that maturity. And there's still lots of unknowns even with cryptocurrencies. We see that being reflected in the performance of IBIT, which is linked to Bitcoin. And then, of course, global real estate down about a little over 5% REET. Now, in terms of some of the other things that I've asked you on the channel, this was an opinion viewpoint question. What will be the best performing ETF asset class for the rest of 2025? Half of you said U.S. stocks. You don't care how poor performing the S&P 500 or NASDAQ 100 has been. You still think, at least half of you, that U.S. stocks are still going to be the best performing asset class for the rest of 2025. That's a bold prediction. That's a bold viewpoint, especially in light of how weak stocks have been. But you know what? If we look at history, it's maybe not so crazy. If you take a look at the top worst performing years for the first 64 trading days, this is courtesy of Charlie Bailello, and it's a pretty neat table that reminds us that if you take a look at the top 5 worst performing years for S&P 500 stocks, you notice that they started out the first 64 days horrifically. But then look at the price return for the final period through the end of the year. It was up every single time. Now, some years it was up dramatically, 1938 and then 2020. But nevertheless, this could rhyme with 2025 if history rhymes, right? You could be right. So as crazy as your thought is that stocks may end up being the best performer in 2025, we'll have to just see if history rhymes and it does end up repeating some of those other years. It remains to be seen. Now, in terms of industry sectors, we've got 11 industry sectors within the S&P 500, and only one is up, and it's up barely. That's the defensive sector of consumer staples, XLP. You'll notice XLU right behind it, another defensive industry sector. And this just is a testament to the overall weakness of all industry groups. Of course, technology and consumer discretionary being the two worst performers. And those have been heavily weighing since they represent such a large portion of the overall S&P 500. That's why we see such strong and deep weakness in the overall S&P 500. Those two sectors have really been weighing. Now, in terms of areas of the ETF market that have been performing very strongly, take a look at these 3x leverage bear ETFs, which have some major upside momentum. We saw a spike really this past week with the mention of sheriffs, rhymes with a T, or starts with a T, rhymes with sheriff. Lots of sheriffs coming out of the White House. Not going to say it. SOXL, linked to semiconductors. TECS, linked to technology. And then SPX, linked to S&P 500. All these ETFs aim for leveraged inverse performance to their respective indexes. So lots of weakness in semiconductors, technology, S&P 500. These ETFs are designed to do the opposite daily performance, 300% opposite daily performance to all of these respective areas of the stock market. And really, that's the time you use leverage. Ron's rule for leverage: if you're going to use it, do it in a market that's sharply trending in a certain direction, and preferably in the same direction you're trading. And so that's what we see right now with these bearish leverage ETFs. They've got a lot of upside momentum. If we organize them from a trading strategic matrix perspective, that would fit into the momentum trade. Number two, they've got lots of upside momentum right now with this weakness in stocks. We've got contrarian trades, we've got income trades, we've got defensive trades. And how do we organize some of these ETF ticker symbols? This is not an exhaustive list, but I did a little bit of research for you just to organize some of these ETF trades and tickers into this strategy matrix. On the offensive or momentum side, you see some of those tickers that we charted in the previous slide: SOXS, TECS, SPXS, and then TMF, which is an interesting one. This one is linked to long-term U.S. Treasuries, which have been strong performers. This one aims for bullish exposure to that area with leverage. So TMF, check that one out. On the defensive side, these are some of the areas that have done relatively better than the broader U.S. stock market. BTAL, we've had that one on one of our episodes of ETF Battles recently. GLDM, which is linked to gold bullion. And then, of course, inverse ETFs also I would consider defensive. The ones that are not using leverage, I would consider those defensive. So something like ticker symbol SH, that would be, to me, more of a defensive trade than something that's using leverage. Whenever you start using leverage, you're looking for some juice. You are, in my viewpoint, you're not being defensive, you're being offensive. You're looking for some quick gains, and it's usually a short-term trade. So that's kind of how I separate some of those inverse ETFs from each other. So the inverse ETFs, again, that don't have any leverage, I would consider them defensive, especially in this kind of climate. And then, of course, those buffered ETFs, which we're going to give more airtime to. The whole point of these types of ETFs is to protect you or give you some hedge on the downside with an upside cap or limit to what your potential gains can be. On the contrarian side, we talked about some of those industry sectors that are weak right now within the S&P 500, XLK, XLY, XLI, and then also critical materials, which we've discussed extensively in our original series, Shifting Energy, SETM, which includes equities within the areas of critical materials, including lithium, nickel, silver. You've got copper in that group. So SETM has been weak. Uranium's also been weak. But again, that doesn't change the longer-term perspective and the longer-term bullish outlook for some of these areas. But it has been a temporary setback. And so these are contrarian trades. Contrarian trades sometimes take longer to work out, right? Longer to profit because markets are going through cycles, right? They're going to have good moods, bad moods, and everything in between. And so some of these contrarian trades may take a little bit more time to work out than compared to, let's say, a short-term momentum trade. You've got your income trades. These are just a couple of ticker symbols that throw off income and have been relatively stable compared to the rest of the market. Now, this fits into your non-core portfolio, this trading matrix, right? Where can all of this, these strategies, where would all of this fit into in your overall portfolio? If we try to segregate it into all these buckets, these three buckets, I would put it in your non-core portfolio. That's a place where you could be strategic in nature. You can be concentrated in a specific asset class. You can use leverage. You can be long. You can be short. That's the non-core portfolio. Core portfolio is very different. It's broadly diversified in nature, and you're not making lots of changes to it. Maybe you're rebalancing, maybe every year or every couple years, but your core portfolio is pretty steady, broadly diversified, low cost. Usually you're using core index funds or index ETFs as the foundation of the portfolio. And then your non-core complements that, right? Your non-core can move around a little bit more and be strategic and use something like this ETF strategy matrix. Now, your margin of safety, we've talked about this on this channel rather extensively. And this is the part of your overall portfolio that gives you stability. It gives you something that the core and the non-core don't necessarily give you. And when we think about all the things that threaten our livelihoods, threaten our financial well-being, there's lots of things. There's taxes, there's market crashes, there's inflation, there's accidents that could potentially hurt us or disable us, illnesses. These are all things that could be financial icebergs. And so when we've got a margin of safety, it gives us that cushion. It provides us with three things: liquidity, zero market volatility, and 100% principal protection. So the investments that we use within the margin of safety should have these characteristics, right? So something, for example, like gold would not meet the minimum safety standard as an asset that could be used in your margin of safety bucket. Why? Well, because gold has volatility, it does not have 100% principal protection. So that's just an example of an asset that does not meet minimum safety standards. Also, the asset that you use for minimum safety standards has to have all three of these attributes: liquidity, zero market volatility, 100% principal protection. It can't be one of three or two of three. It has to be all three. And so gold, by that definition, does not meet minimum safety standards. Neither do U.S. Treasuries. They may provide you some liquidity, but they're going to have volatility, and they don't necessarily give you 100% principal protection. So what are the types of assets or investments that have minimum standards of safety? Well, there's three. You've got CDs, which are FDIC-insured deposits. That is a minimum standard of safety, right? It gives you that liquidity. It gives you that zero market volatility and that 100% principal protection. Same thing goes for buffered ETFs that have 100% buffers or 100% hedges on the downside. Those do qualify as a type of asset that could be used in your margin of safety bucket. Same goes for fixed annuities, which give you a fixed interest rate, much like a bank CD, or an indexed annuity, which also provides you 100% principal protection, but has your money linked to a specific index. So we're going to talk about this. I've got another episode. I'm going to give you an example, again, of I'm going to just take one of these products, isolate it, and give you some examples of how it works, just so that you understand it. And I don't think any three of these particular choices is necessarily a bad choice. I think a lot of it depends on the size of your investment portfolio. I think you could use all three. Some of you may decide to use one of three, two of three, all three. A lot of it depends on you as a person, depends on the size of your portfolio. For example, if you've got a really big portfolio, the disadvantage of the CDs is the limited protection, right? A lot of these limits, $250,000 per account. If you've got a really big account, you may want to look at these other choices, which give you a little bit more asset protection compared to a limited dollar amount like you might get with a bank CD. Now, this whole idea of margin of safety, core portfolio, non-core portfolio, I talk about this in my book, Portfolio Architecture. I encourage all of you to get a copy. You can also listen to it as an audio or audiobook. And I've got a link in the description section below so you can get that. Also, I want to make an announcement for those of you with a 401k plan that are maybe it's something that you implemented yourself, or if you're in a small business or mid-sized business and you're looking to have ETFs with, for example, these buffers, right? Some protection on the or on the downside, or some hedges on the downside. These are things that are included in the ETFK retirement plan that I have built and designed. You can go to etfk.com to learn more. And really, ETFs up until now have been very small players in the 401k market. That's changing. And so ETFK offers a lot of great choices. Beyond just the buffered ETF choices, we've also got a lot of different fund firms, including Vanguard, BlackRock, Fidelity, as well as State Street Global and others. So be sure to check that out, etfk.com. Finally, don't miss any of our programs. We don't just broadcast here on YouTube. You can also check us out on Roku, Amazon Fire, as well as Apple TV. And that's about it for today's episode. Hopefully you enjoyed it. And hit me up in the comment section below. How are you doing so far in 2025? Give me an update on your investment performance. Which ETFs have you been using? Have you been using any of these strategies we've talked about? Margin of safety, having some stability in your portfolio that complements your core and your non-core. Hit me up again in the description section below. I'm Ron DeLegge with ETF Guide. Thanks for watching. We'll see you on the next episode.